As precious metals investors, we're all looking for an edge. We're all looking for some general rules that will help us to identify favorable times to buy the metals and times when it is best to hold off on making new purchases or even sell some metal. It's pretty difficult just taking a look at a price chart alone and determining good times to buy, good times to sell, and good times to trade one metal for another. I've done considerable statistical work showing that there's not much exploitable information available in price trends. The autocorrelation in the data is very weak. So weak, in fact, that attempts to use technical analysis will, on average, cause you to erode your wealth due to transaction spreads, taxes, and the long-term relentless destruction in the value of fiat currency. It's for this reason that I've always been an advocate of simply accumulating gold and holding it for the long term. A person who just takes surplus dollars every month and buys a little gold and holds for the long term can actually do quite well. Let's assume a person has $100 of surplus wealth at the end of each month in constant dollar terms. This person started accumulating gold in the early 1970s and without fail simply bought at the end of every month. Yes, there were long stretches of time when our saver would have been better off just holding dollars, and some times when he or she would have been better served holding silver. I've shown you in many videos how to use the gold to oil ratio and gold to silver ratios to determine those times. But for now, let's just assume our metals investor wants to take the simplest approach possible. What would have been his rate of return? Quite simply put, it would have been 6.2% per year, completely tax deferred, which is not a bad showing at all. Though we have to bear in mind that a little of this 6.2% is not really gold becoming more valuable. It's simply a reflection of the constant and relentless erosion of the value of the dollar, which is the main reason why we buy precious metals in the first place. Let me restate this. We buy precious metals not so that we can accumulate more dollars. We buy them so that we can avoid holding dollars and falling victim to the long-term destruction of value caused by currency inflation. And given that the gradual destruction of a corrupt money is virtually guaranteed, I'm quite comfortable recommending to people that they simply buy gold with their dollars and hold the gold, provided that they understand the nature of gold and are comfortable with some fluctuations in price. But a portion of the 6.2% yearly increase in price is real appreciation in the value of gold. Let me show you. We can use many purchasing power measures. Here I'll use the continuous commodity index to measure the purchasing power of gold relative to a basket of important commodities. Notice that over 47 years, gold has increased in value relative to other commodities at a rate of 4.7% per year. Now, why is this the case? Well, if you go back to my Good Money Appreciates video series and review the material, you will see that holding gold as money allows you to reap the benefits of productivity improvements. Over time, technology reduces the cost of producing goods and services. A good, sound money allows the saver to see a gradual improvement in standard of living. The benefits of technological progress accrue to the holder of good money over long periods of time. And over the past 47 years, we've seen lots of progress, and so our gold holder has seen improvements in standard of living that our dollar cash holder would not have benefited from. Sound money appreciates in value. Corrupt money depreciates in value. It's that simple. Remember this, and you'll do very well. That said, I've introduced to my subscribers some tools which can be used to avoid making purchases at the wrong times. I've shown how the value of gold relative to oil can be used to identify good times to buy gold and good times to delay the purchases of gold in the hopes of more favorable prices. The gold to oil ratio is a very useful tool, and it can be used to improve purchase price points considerably. Still, it needs to be viewed as only a tool that can be used to provide some short-term guidance and get a person into gold at better price points. I generally don't advocate selling gold for dollars, except when the gold to oil ratio reaches extremes. It's more of a tool that can be used to aid you in your accumulation process, not one that should be used for frequent trading. But today I'd like to discuss another tool that can be used, and that is seasonality in precious metals prices. There are certain times of the year that are more favorable for purchasing than others, and being aware of these times can help you to accumulate at slightly better prices. Let's start by taking the monthly closing prices of gold and overlaying a 1-year moving average of the price. Why 1 year? Well, let's assume that a person is comfortable holding some cash for up to a year, but really would rather hold gold or silver instead. After all, the longer our investor holds corrupt money, cash, instead of holding good money, gold, the more likely it will be that our investor will fail to reap the benefits of productivity improvements. We can use the moving average price to determine if there are certain times of the year that tend to offer better prices than others. By simply calculating the difference in the monthly price and the moving average, we can see how the percent premium or discount to the yearly average has changed over the past 47 years. When the percent difference is positive, it means that if you buy at that time, it will be at a higher price than you could get for most of the rest of the year. When the percent difference is negative, it means that you'd be purchasing at a discount to the price that you'd have to pay on average for the year. So obviously, buying when gold is at a discount is a good thing for our saver. As we can see, there is quite a bit of volatility in the price of gold around its moving average. There are some extreme points where the premium or discount is more than 10%. These are the times when the gold to oil ratio can come in really handy. Most of these points tend to happen at times, though, when the gold to oil ratio is at an extreme. But what about other times? There are periods of time when we should still be able to get a few extra percent gold for our money, which the gold to oil ratio can't really help us to identify. Are there certain times of the year when it's better to buy than others? The answer to that is yes. Let's calculate the average premium for given months. Here's the result. Notice that there are some months when it's better to buy and some months when it's better to wait. June, July, and August tend to be better than January, February, and March. Saving some cash during the winter to be used to buy gold in the summer can provide some modest benefit to the gold holder. But it's not a tremendous benefit, but certainly one that can be used to offset the retail premium associated with buying real physical gold. But the picture for silver is much more dramatic and should be of interest to our silver investors. Let's overlay the silver seasonality and see what it looks like. For silver, January through May tend to have much higher prices than for the remainder of the year. Thus, a good rule of thumb would be that cash should be accumulated in January through May to take advantage of weaker silver prices that are offered later in the year, because evidently silver can, on average, be bought much more cheaply in the second half of the year. If purchases are avoided in the early part of the year, when prices are at a premium of about 2%, and the cash used to buy silver during the weaker months, when silver is at a 2% discount, it means that our saver will have 4% more silver for their cash. For a saver, a 4% difference in wealth can be significant. It will be interesting to see what happens in the second half of this year. Will silver prices weaken, as has been the case in the majority of the past 47 years? It's possible. We'll have to wait and see what unfolds. Let's summarize our findings here. There is seasonality in gold and silver prices. The seasonality in gold is modest, but the seasonality in silver is fairly dramatic. The main lesson here for silver is that better prices are generally offered in the second half of the year than the first half. The difference is meaningful and may be used to the saver's advantage. Again, though, it's just a tool. Don't try to use it as a trading tool. Simply use it to help yourself obtain more metal for your surplus cash.